Hello, everyone. Andrew here. I truly appreciate you taking the time to join me today. If this is your first visit to the channel, welcome to New Tax Service. Our focus is helping individuals and business owners understand taxes in a way that actually makes sense. We believe education removes fear and confidence comes from clarity. When you understand what is happening with your finances, you make better decisions and experience far less stress. Today, we are diving into a subject that generates curiosity, excitement, and sometimes unrealistic expectations. We are discussing how small business owners can legally pay $0 in taxes step by step. Let us start by setting expectations correctly. This is not about secret tricks. It is not about hiding income. It is not about bending rules. It is about understanding how the tax system is structured. The system encourages business growth, investment, job creation, and reinvestment. Those incentives exist on purpose. When used responsibly and consistently, they may significantly reduce tax liability. However, this outcome requires awareness and planning throughout the year. It is not something that happens overnight. Let us begin with the first major element, structure. Business structure influences how income flows and how taxes apply. Many individuals begin operating as sole proprietors. This is simple, yet simplicity can limit options. Forming an LLC may create separation and open flexibility. Choosing S-corporation treatment may change how earnings are categorized and taxed. Now I want to spend meaningful time on another structure because it deserves deeper understanding. The C-corporation. A C-corporation exists as its own taxpayer. This means the business and the owner are separate from a taxation standpoint. While people often focus only on potential double taxation, there are strategic advantages worth considering. Imagine a business generating substantial profit but planning expansion. Rather than profits immediately increasing personal taxable income, some earnings may remain within the company to fund hiring, marketing, equipment, or infrastructure. This can support scaling without immediate personal tax impact. Additionally, benefit structures may be handled differently. Health coverage, retirement contributions, and employee-related support may offer positioning advantages depending on planning. There is also perception and capital access. Investors and lenders often associate corporate structures with readiness for scale. This can influence funding opportunities. However, responsibility increases. Record-keeping expectations, governance activity, and compliance obligations are higher. Therefore, structure must align with long-term vision rather than impulse decisions. Now, let us transition into one of the most impactful areas, deductions. Deductions represent recognition of legitimate business spending. Every business uses tools to operate. Software, advertising, consulting, supplies, internet services, and infrastructure are examples. When documented properly, they reduce taxable income. Let us go deeper here and walk through realistic everyday scenarios. Consider a small creative business owner. They subscribe to editing platforms, scheduling tools, cloud storage, and client communication software. Individually, these charges may appear minor. Over 12 months, they accumulate significantly. Categorizing these expenses ensures they contribute properly. Think about workspace development. Purchasing monitors, lighting, or printers improves productivity. When used for business activity, tracking these investments matters. Marketing provides another example. Paid advertising campaigns, branding work, photography, and web hosting all support visibility. Proper classification turns growth spending into recognized expense activity. Professional guidance should not be overlooked. Working with accountants or advisors supports compliance and planning. These relationships are part of responsible operation. Educational growth connected to business skills can also contribute. Training courses or certification programs that improve capability may qualify when tied directly to operations. Travel tied to legitimate meetings or events introduces another dimension. Documenting purpose and timing ensures clarity. The strongest deduction approach is consistency. Routine tracking eliminates last-minute stress and increase accuracy. Now I want to discuss audit awareness in depth because confidence in this area changes mindset entirely. Audits are often misunderstood. Many are simple requests for clarification. Systems identify unusual patterns and request supporting detail. When records exist, resolution becomes manageable. Certain behaviors attract attention. Large deductions unsupported by documentation, inconsistent reporting across years, or unclear separation of personal and business activity may prompt questions. Preparation removes fear. Imagine two scenarios. One business owner tracks expenses weekly and stores receipts digitally. Another reconstructs activity from memory months later. The difference in confidence and clarity is substantial. Viewing compliance as empowerment creates confidence. Organized documentation allows you to pursue legitimate strategies without hesitation. Professional support adds reassurance when communication is required. Now let us discuss real-world perspective. Reaching zero tax liability often occurs during growth phases where reinvestment offsets profit. This is situational and should not be forced. Sustainability always outranks short-term positioning. Think of tax planning like maintaining health. Consistent discipline creates stronger results than reactive effort. At New Tax Service, our work centers on guiding business owners through structure evaluation, documentation strategy, and planning alignment. Education and partnership drive confidence. We're going to build further into the application side so this knowledge translates into action. At the start of each year, business owners should confirm that record-keeping systems are functioning smoothly. Bank account separation, expense categorization, and tracking tools should already be in place. This is also an ideal time to review whether your entity structure still matches your revenue scale and operational goals. During the first part of the year, documentation habits should remain consistent. Monthly financial review allows you to identify trends early rather than discovering surprises later. Quarterly estimated payment evaluation should align with income patterns, so obligations remain balanced. Mid-year presents opportunities for reinvestment decisions. Equipment upgrades, operational software expansion, marketing pushes, or workflow improvements should be evaluated strategically. Understanding how these investments affect financial positioning encourages intentional decision-making rather than reactive spending. Later in the year, retirement contribution potential should be assessed before deadlines. Equipment needs should be reviewed in light of depreciation considerations. Eligibility for credits connected to operational activities should be explored proactively. Let us also highlight frequently overlooked deduction categories that deserve attention. Payment processing fees accumulate across digital transactions. Website maintenance and hosting support ongoing presence. Communication platforms and business phone services represent operational cost. Insurance tied to business protection is relevant. Small recurring office supply purchases collectively impact totals when tracked. Documentation discipline remains one of the most powerful habits a business owner can develop. Storing receipts digitally, reconciling statements regularly, and backing up records reduces errors and strengthens accuracy. Reviewing financial statements quarterly enhances familiarity with activity patterns. Strategic restraint is equally important. Aggressive positioning without documentation increases risk. Balanced, informed decisions protect sustainability. Ultimately, structured habits shape outcomes. Organization, review, awareness, and planning work together to influence positioning. There is rarely one single factor that determines results. Instead, it is the accumulation of consistent behavior over time. Before we conclude, let us directly connect everything we have discussed back to the core question of how a small business owner may legally reach zero tax liability. This outcome does not come from one isolated tactic. It happens when strategies are layered correctly. Taxes are calculated on profit, not gross revenue. Legitimate business expenses reduce profit first. Retirement contributions and certain qualified deductions reduce taxable income further. Depreciation from equipment or asset investment can reduce it again. Finally, applicable credits may offset remaining liability directly. In practical terms, revenue enters the business. Operational expenses reduce profit. Contributions and allowable write-offs reduce taxable income. Credits address remaining obligation. During heavy reinvestment phases or expansion cycles, these combined effects can result in nothing owed. Structure affects how this process functions because income flow differs by entity. Timing influences which year activity appears. Documentation validates legitimacy. Each piece connects to the outcome. It is important to remember that zero liability is not a guaranteed yearly result. It commonly occurs when profits are redirected into growth or long-term planning. Responsible strategy focuses on accuracy and sustainability rather than chasing a number blindly. This layered approach is how we guide clients at New Tax Service. We examine real activity, apply lawful provisions, and build strategy grounded in compliance and clarity. If this extended discussion provided clarity or value, please subscribe, like this video, and share your thoughts in the comments. Your engagement allows us to continue producing meaningful content. Also, remember to click the link provided in the description to visit our website and learn how New Tax Service can support your journey. I appreciate you for being here today. New Tax Service is here to help you turn knowledge into action. Stay informed, stay intentional, and I will see you again soon.